Hello, everyone. A huge welcome to all of you. Thank you so much for clicking on this video and spending a little bit of your day with us.
We're really glad you're here.
We really are, because we have a massive topic to break down today. It's February 2026. The numbers are officially in, and Amazon has just dropped a quarterly report that, it basically redefines corporate investment.
Yeah, we're not just talking about e-commerce anymore.
Yeah.
Not by a long shot.
No. We're looking at a company that is, it feels like, attempting to rebuild the physical and digital infrastructure of the global economy.
And that is not an exaggeration. Usually earnings calls are about, small adjustments, a percentage point here, a little margin improvement there. This was different.
Very different.
This is about a fundamental shift in the plumbing of the internet, a huge bet on custom chips, and a capital expenditure plan that makes some countries look, well, frugal.
So we've got the earnings release, the CFO commentary, and a very spicy Q&A session with Wall Street. Our mission today is to figure out exactly where Amazon is putting all this capital.
And what that tells us about the future of AI, of retail, and, well, everything else.
It all starts with a headline number that involves a B.
A very big B, as in $200 billion.
We will get to that massive number, I promise. But let's ground this in the Q4 2025 performance first, just to set the table.
Okay.
So Amazon pulled in $213.4 billion in revenue for the quarter. That's up 12% year over year.
And that's excluding foreign exchange rates, right? When your revenue base is that large, just sustaining double-digit growth is incredibly difficult. It tells you the core engines are not slowing down.
And the profitability story, that's interesting too. Operating income hit $25 billion, but that number is actually, a bit cleaner than it looks on the surface.
Right, because it includes about, what was it, $2.4 billion in one-time charges.
Exactly. A tax thing in Italy, some severance costs, asset impairments for physical stores. So the underlying engine is actually running hotter than that headline number suggests.
Yeah, strict those out, and the operational efficiency is even more impressive. But if you want to see the real engine, you have to look at AWS.
Oh, absolutely. The cloud division grew revenue by 24% year over year.
Which is the fastest it's grown in 13 quarters.
Mm-hmm.
They're now on a $142 billion annualized run rate. Just incredible.
So just to put that in perspective for you watching, AWS alone is bigger than the GDP of a lot of countries. But of course, growth requires fuel.
A lot of fuel.
And this brings us back to that number you mentioned. The CEO, Andy Jassy, announced a capital expenditure plan, a CapEx plan of roughly $200 billion for 2026.
$200 billion. This was the moment on the call where you could almost hear the analyst's jaws hit the floor. It's a staggering amount of money for infrastructure in 1 year.
He was very clear where it's going.
Oh, yeah. It's mostly for AWS and AI.
Mm-hmm.
And his whole argument is that this isn't speculative. They are monetizing capacity as fast as they can build it. It's not a build it and they will come situation.
It's more like they are already here and we're scrambling to build it fast enough.
Exactly.
But here's a nuance that I think is so critical. They aren't just taking that money and, handing it all over to NVIDIA.
No. And that's the key. That is their strategic differentiator. A huge chunk of this build-out is for their own custom silicon.
Their Trainium and Graviton chips.
Right. And Jassy said that business alone, just their internal chips, is now over a $10 billion annualized run rate.
That basically makes Amazon one of the world's biggest chip companies, and it's just like buried inside a retailer.
And they also touched on this new tech, NovaForge and Novellas. Jassy used this really great analogy to explain it.
Well, the language learning one.
Yeah. He said if you want to teach a kid a second language, it's way more effective to do it when they're a toddler than an adult. NovaForge lets companies mix their own data into an AI model at that toddler stage.
The pre-training stage, so it bakes the knowledge right into the foundation.
Exactly. Instead of just painting it on top later. For, a bank or a hospital, that's a huge deal for accuracy. It's a game changer.
Okay, so that's the cloud. But we can't ignore the physical side of the business. What stood out to you in the retail updates?
Speed. It was all about speed. The expansion of Amazon Now, that's their 30-minute delivery service, is changing how people shop.
And they noted that everyday essentials, soap, toothpaste, dog food, that kind of stuff, is now 1 out of every 3 units they sell.
That drives habit.
Of course it does. If I can trust you to bring me toothpaste in 30 minutes, I'm probably going to trust you when I need to buy a new TV. And speaking of buying that TV, they updated us on Rufus, their AI shopping assistant.
300 million customers used Rufus in 2025. You can really see the shift from search to, like, consultation in online shopping.
And finally, before we hit the Q&A, there was a big update on connectivity, Amazon Leo.
Project Kuiper. It's finally going live. They announced the Leo Ultra antenna, which can hit gigabit speeds, and they're targeting a commercial launch this year, in 2026.
So this year, Amazon becomes a global ISP from space.
Cloud, chips, retail, space. The ambition is just, it's staggering.
But Wall Street's job is to worry about the cost of that ambition, right?
Yeah.
And the Q&A session was, let's say it was tense. They were really trying to poke holes in that $200 billion spend.
It started right away. Mark Mahaney from Evercore ISI, he went straight for the big question, return on invested capital, ROIC.
He was basically asking, okay, $200 billion is great, but how long is the payback period? Is this even sustainable?
Exactly. And the CFO, Brian Olsavsky, he started the defense by pointing out that there's no idle time. The gear's being used the second it's plugged in.
And he said that AWS operating margin is still healthy, right, at 35%.
Right, even with all the AI headwinds. But then Jassy stepped in with the big strategic argument. He called this an unusual opportunity and insisted this isn't what was the phrase? A quixotic top-line grab.
Quixotic, I loved that. He's saying they aren't chasing a fantasy here.
No. But the real insight was about margins. Jassy's argument is that because they own the silicon, the Trainium chips, their cost basis is just lower than competitors who have to buy expensive GPUs from someone else.
So they expect margins to actually improve over time because they own the whole stack.
That's the bet. That vertical integration is their moat.
And that leads perfectly into the next question from Doug Anmuth at JP Morgan. He wanted details on Project Rainier.
The Anthropic partnership.
Yeah, he was digging into the chip volumes, the rumors about 500K versus a million chips.
And this is where we got the hard specs. Jassy confirmed Anthropic is training its next big model on Trainium 2. That is a massive vote of confidence.
If a top-tier AI lab like Anthropic is using your chips instead of NVIDIA's,
Then your chips work.
yeah.
And they work well.
And Jassy dropped some numbers here too, saying Trainium 2 offers 30 to 40% better price performance than comparable GPUs.
Which, if you're a startup burning through cash, that kind of savings is everything. He also mentioned the supply for the next chip, Trainium 3, is already almost fully committed through the middle of this year.
So it just reinforces that point about demand completely outstripping supply.
Yep, and he said it again. Trainium plus Graviton is now north of a $10 billion business for them.
Okay, so the next question was from Ross Sandler at Barclays, and it was a bit more philosophical, but I think really important. He asked if the AI market is too top-heavy.
Right. Is it just a few big labs spending all the money? What about everybody else?
And this was my favorite part of the call. This is where Jassy introduced his mental model of the barbell economy.
Let's unpack that, because it's a great way to think about it.
So he's saying, imagine a weightlifting barbell. On one side, you have these massive weights. That's the AI labs training huge models, a few runaway apps with tons of users.
And on the far other side, you have the other set of weights. That's enterprises doing what he calls the boring productivity work. You know, coding assistants, customer service bots.
So high-end research on one end, basic cost-cutting on the other. What's in the middle of the bar?
That's the whole point. Right now, the bar is pretty thin. The middle is what he calls production workloads. Mainstream companies completely reinventing their core products with AI.
And he's saying that middle part hasn't really arrived yet.
Not fully, but he sees that as the massive opportunity. We're still early. That middle is where all the long-term volume is going to be.
So if you're listening to this and you're worried you missed the AI boom, Jassy's point is that the main event, the middle of that barbell, it hasn't even started yet.
Precisely. And he also mentioned OpenAI, confirmed they have a strong relationship, but really emphasized that this market is going to support thousands of winners,
Yeah.
not just one or two.
Okay, moving over to retail. Michael Morton from MoffettNathanson asked the sort of the existential threat question.
The agentic AI question.
Yeah. If I have a generic AI agent on my phone, does it just bypass Amazon's storefront and ads completely?
This is the big fear, right? That some AI will just buy your toothpaste for you, and you never visit Amazon.com again, and their ad revenue just craters.
Jassy seemed really ready for this one. First, he drops a stat that users of Rufus, their own agent, convert 60% more often. But his main point was about horizontal versus vertical agents.
Right. A horizontal agent is a general chatbot, knows a little about everything. A vertical agent, like Rufus, knows everything about one thing, in this case, Amazon's inventory.
And Jassy's argument is that The generic agents will fail at the last mile of data. They won't know the real-time price or the exact inventory or if a return is going to be easy.
He's betting that trust and logistics are a moat that pure software can't cross. He basically said, we are better at taking care of you than a generic chatbot. And, strong argument.
It is. Next up, Brian Nowak from Morgan Stanley wanted to know about global retail, the balance between growth investments and, cost savings.
The classic Amazon balancing act. For growth, Jesse pointed to luxury fashion and, again, Amazon Now. He had a great stat from India.
What was it?
Users of Amazon Now in India tripled their shopping frequency.
Tripled. Okay, that explains why they are pushing speed so hard. If you can get it that fast, you just buy more often.
And then on the cost side, it was all about robotics. They have over 1 million robots deployed, but he was clear that's just a fraction of the potential. They're going to keep using robots to lower that cost to serve.
And finally, Eric Sheridan from Goldman Sachs asked about the backlog.
The signed contracts that haven't been billed yet. And the number is just huge. $244 billion.
$250 billion in future revenue locked in.
Yeah, up 40% year over year. But Sheridan also asked about the supply crunch.
And this is where the physical reality of AI really hits home. Jassy just admitted it. He said they could grow even faster if they had more capacity. The bottleneck isn't demand, it's power.
He said they added 3.9 gigawatts of power in the last 12 months. That's double what they had in total back in 2022.
3.9 gigawatts, that's like, what, 4 nuclear power plants worth of power capacity in 1 year?
In 1 year. And they're still scrambling for more. It just underscores that AI isn't code. It's concrete and copper and power plants.
So we've dissected the $200 billion, the custom chips, the barbell. If we zoom all the way out, what are the big takeaways here?
I think there are 4 clear themes. First is what I'd call the infrastructure pivot. Amazon is becoming a chip and infrastructure utility. That $200 billion is a bet that owning the silicon gives them a structural cost advantage. They want to be the low-cost provider of compute.
Okay, theme 2 has to be that barbell market. It's so important for understanding how long this cycle can last. Jassy is signaling that the middle of the market, those enterprise apps, that's the next huge wave. We're not at the end of the hype cycle.
Not even close. We're just waiting for the enterprise implementation cycle. Theme 3 is the evolution of retail. It's not about 2-day shipping anymore. That's just expected. The new battleground is 30-minute delivery and AI agents that you actually trust.
They're using speed to turn Amazon from a store you visit into a utility you just rely on.
And the last one, theme 4, is space. It feels like a side project, but 2026 is the year Amazon becomes a global telecom provider. If Leo Ultra works, they open up a revenue stream that's completely separate from retail or cloud.
It's a fascinating ecosystem. A company that's dominant in retail, dominant in cloud, is now challenging NVIDIA in chips and Starlink in space.
It is, without a doubt, the most ambitious industrial plan in the market right now.
It is certainly a $200 billion question. We will be watching very closely to see if that barbell middle fills out the way Jassy predicts. I think that's all we have for this breakdown of Amazon's Q4 2025 earnings. If you found this analysis helpful, please go ahead and click that like button, maybe share this video with your network, and subscribe to the channel so you don't miss our next one.
Thanks so much for listening.
Stay tuned for more upcoming content on the tech landscape. We'll see you next time.